I was very loud at the start of the year saying I think it's going to be a melt-up year because of the pre-election year dynamics, but that there's a credit event out there. And I've increasingly been kind of sounding the alarm, saying the conditions are now there, not just from a seasonality perspective, but from a sentiment perspective and from the standpoint of a lot of these intermarket relationships that I'm known for, that I track, these papers that I put out that are undeniable in terms of what they're actually showing, because it's just pure math and numbers. And I have to tell you that because the melt-up has been so strong this year, I would argue the only way you stop it is with something that's a shock. It has to be something that comes from left field.
Welcome, everybody, to Soar Financially. Thank you so much for joining us. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. We have a fantastic conversation, I think, lined up for you today. It's we're joined by Michael Guyett. He's the editor, publisher of the Lead Lag Report. And, you know, we're in the middle of the summer doldrums, seemingly, but we got a lot of news the last 24 hours that might trigger a bit of a reaction in the market and from us investors as well. Might, while we're sitting at the pool sipping on margaritas, might give us a little pause at least, and might want to check us some news websites here. Really looking forward to that. And let me bring my guest on. Michael, it's great for you to join us here on Soar Financially. Been looking forward to this conversation for a while. Thanks for your time.
Well, I think if people are going to be having margaritas now, they might need to get a whole gallon or carafe of them if things are going to get volatile here.
Yeah, it's just a sangria carafe with a nice straw or something. It's probably a good idea in this market. Absolutely. Michael, let's start the conversation off with a bit of scene setting here. Let's talk about how you rate the current state of the economy, because that will sort of lead us into details like Treasuries, US dollar, and of course commodities.
Yeah, well, I mean, I think it's always important to recognize that the markets and the economy are not one and the same, right? I mean, just like a company is not the exact same as a stock, right? Because of valuations, I'd argue the same. Clearly, the economy has been resilient. Clearly, you have not had housing break as much as I thought it would when I kept on screaming very loudly that I think housing's in trouble. And clearly, unemployment really hasn't shown any signs of major cracking, at least not yet. Now, I think, and I could be wrong on this too, I think that's because there are delays. There are lags, in terms of interest rate policy and what's happening on the ground, right? So this is the thing. I think a lot of people don't understand the difference between lagging, coincident, and leading. There aren't that really many leading indicators. Most things that people reference as leading are in fact either lagging or coincident. I'd argue, by the way, the Federal Reserve also falls for that trap, right? Now, that's on the economy side. I do think the economy is going to be challenged at some point because these incredibly high credit card rates, which don't seem like they want to go down again anytime soon, are at some point going to be problematic for the consumer, right? So on the one hand, you have this lock-in effect of low rates from people getting mortgages, from 2-3 years ago. On the other hand, you've got revolving credit, which is getting more and more expensive, right? So I use that line a few times as a take on Ernest Hemingway's quote, right? Slowly, then all of a sudden. At some point, I think that side of the economy is going to deteriorate. Now, as far as the market itself goes, it's always a question of which market we're talking about. I was very loud at the start of the year saying I think it's going to be a melt-up year because of the pre-election year dynamics, but that there's a credit event out there. And I've increasingly been kind of sounding the alarm, saying the conditions are now there, not just from a seasonality perspective, but from a sentiment perspective and from the standpoint of a lot of these intermarket relationships that I'm known for, that I track, these papers that I put out that are undeniable in terms of what they're actually showing, because it's just pure math and numbers. And I have to tell you that because the melt-up has been so strong this year, I would argue the only way you stop it is with something that's a shock. It has to be something that comes from left field. So we can take it any which way you want, but bottom line is economy is not the stock market. Economic metrics that matter tend to be referenced, which are mostly lagging and coincident, not leading. Credit card interest rates are going to be a problem at some point for the consumer, and unemployment, I think, still is going to tick up probably sooner than people realize.
Yeah, no, absolutely. And 3.6%, I don't think is sustainable based on what we're seeing on the macro scale, right? There's so many factors going into that. Just looking at the ADP numbers today, of course, they surprised to the upside, but I think a lot of that was just seasonality as well. I looked at leisure and hospitality, I think were the main drivers. We're in the middle of the summer. Obviously, there's going to be leisure and hospitality, a little boom in there. But come September, October, do you expect, of course, that number to die off again and maybe completely reverse?
Well, I don't know about completely reverse, but I mean, these numbers are notorious for getting revised, right? So it's
Sure.
like the market responds off of the headline numbers, but then somebody seemingly forgets that when the revisions happen, there's like no reaction, which is just kind of, I think, comedic in and of itself. But look, we are seeing bankruptcy filings picking up factually on the ground. You have a big disconnect between bankruptcy filings and credit spreads, default risk getting priced into the bond market. You've got a tale of two messages when it comes to the bond market. The inversion is saying recession. Credit spreads are saying no recession. One of them is wrong, right? I suspect it's more the credit spread side of things. So, yeah, I mean, I think the moment you get any kind of real volatility that's persistent, where you break the illusion of consistency, right? That makes CEOs and HR managers start to realize, well, you know what, maybe we have to change up our company plans. That's probably when you start seeing the unemployment side really getting more interesting.
The U.S. The Fed came out with a bank survey 2 days ago as well, sort of hinting at weaker loan demand, meaning small businesses are not really drawing credit right now because credit is just too expensive, and tighter credit as well. So the banks are not willing to loan out money right now as well. So where do you see that heading? Like, I'm just looking for a dynamic. I'm German. I always look for the straw that breaks the camel's back. You mentioned housing as well. We'll probably get to that in a second. But let's stay on credit for a second. We're not there yet where it's breaking anything, but the indications are there. Is that a leading indicator you're looking at? Weaker loan demand, smaller businesses drawing less money from the banks, and of course the banks not willing to give more.
Yeah, I think. Look, I mean, at some point, all that matters. I've used that line, a few times, right? Nothing matters until it matters, and then when it matters, it's the only thing that matters, right? So it kind of gradually happens, then all of a sudden it starts to matter. But the thing is, like, if you have any kind of a spark of a credit event, right? Whether it's this debt downgrade by Fitch or the risks I'm highlighting with Japan and the reversal of the yen-carry trade and currency volatility, all that ends up having domino effects, right, on everything else. So we're still in the early innings of trying to see how this shapes up. There's a lot of question marks as to not just whether it's in a credit event or not, but the proper way to play it. People forget that you can have a thesis, but how you express on the thesis is really important, right? The opportunity set is as important as your signal, as your look back period, right? Which I'm sure we'll get into too. But the point is that I think a lot of the stuff that's happening now is much more nuanced and very fluid.
That timing is another one as well. So when does the lid blow off, right? As well, because the economy is seemingly doing well based on the GDP numbers we just got. I think it's 2.6% year over year GDP growth, the highest in the G7, which is a mind blowing number. But
Yep.
have you lifted the skirt a little bit? Have you looked, underneath it? Like, what is how is that GDP number derived? Like, what is that coming from? Because I hear automotive was a big one time effect there.
Yeah, I haven't done that type of deep dive, although yes, I'm sure there are a lot of one-time things. But also keep in mind, it's like GDP growth that's coming out is based on rates that were lower, because again, it takes 9 to 12 months, right? So it's like we're still seeing the tail effects of the Fed being so lagged to begin with in hiking rates relative to the pure amount of money supply that's been out there. Again, I go back to this is what people are not, I think, really appreciating. What we're seeing in terms of the in quote strong economy is based on rates from like probably June of last year, when you still had very high inflation relative to rates. There are delays. So yeah, that's why I think a lot of the stuff you have to be careful in terms of trying to say, oh, look, everything's fine. The bull market rages on and we threaded the needle. Even the Fed doesn't know what these lags look like.
Well, we're 15 months now into the rate hike cycles. Like the banking crisis earlier in March was the first indication that caught people off guard.
Yep.
Do you see similar shocks now? A guest on the program mentioned the yellow trucking company going belly up yesterday. I think yesterday or earlier this week, having issues to refinance only $1 billion. So, like, only it's a big number, but in the grand scheme of things, it's not that much. Do you see more of that happening? Like, where are you looking? Like, maybe that leads to the question, like, what's your favorite leading indicator right now? What are you looking for?
Well, so I wish I had $1 billion to refinance myself, in fairness. But this is why I always go back to conditions, right? It's and like some people, I get it. They hear me say that and they, roll their eyes, and it's like, it's a sarcastic, oh, conditions, not call. Of course it's conditions, right? Because nobody knows the exact mile marker that something might happen. Nobody knows the exact catalyst. I mean, if I'm right that the conditions favor a credit event, maybe it has nothing to do with Japan and nothing to do with the Fitch downgrade. But when the tinder is dry, it can get lit up, right? That's kind of the point of this. So yeah, I do suspect you're going to see more of these kind of tail dynamics play out. Now, keep in mind, again, going back to delays, right, and lags, you have a lot of zombie companies. It's like none of that went away. Just people forgot about the zombie company dynamic because stocks are, or at least the NASDAQ and large caps are close to the all-time highs in nominal terms, not in real terms. I keep emphasizing that point. So you got higher rates, companies that still have to deal with those higher rates when they refinance and roll over their debt. It's not just that particular instance. You're talking about a lot of companies that conceivably could just go belly up and call quits because they can't deal with the higher rates. And a lot of these players, I think, are hoping that rates fall in time for them, when the refinancing time period hits. But it just seems to me like that's still going to be you're going to have more of these kind of ongoing headlines like that. Again, whether it matters or not for the broader stock market's a whole different question. But the idea that things have yet to break, I think, is silly. They're in the process of breaking. By the time they're broken, it's going to be too late to do anything about it.
What's your opinion on a rolling recession? Like we're looking at various industries. For example, tourism and the cruise ships are the top performing stocks in the S&P 500. But you look at yellow trucking companies or commercial real estate; they're doing horrible, right? So it seems like some parts of the markets are affected, some are not. So that buzzword "rolling recession" I keep coming back to. Like, what's your opinion on that?
Yeah, maybe. I mean, I'm a little hesitant on that idea because I think when things break, they all correlate, right? I mean, in general. But to your point, it's like I just had a concert yesterday, right? It's freaking jam packed. I mean, everyone's spending. I'm actually blown away. I look at these people. It's like, first of all, they're not exactly dressed like they have a ton of money. So they're probably maxing out their credit cards to begin with. But the point is, like, yeah, there's a lot of residual demand that's still ongoing, right? I mean, you see that just even in terms of ticket sales. If you try to go to any event, people want to go out and spend. They want to be out. They want to still, YOLO and use their debt because they can always, in their minds, pay it later. But this is why I keep going back to there's going to be a delay because, to the extent that a lot of this is being propped up by demand from consumers for things like hospitality, going out to eat, vacations, rentals, all this stuff. It's like, okay, so they keep charging off the credit card, but they don't realize right away that the interest rate has gone up to now 20, 25, 30%, right? The average rate now, last I checked, was 25%. They realize it with a delay too, right? So, and that's what causes the change in behavior. So I don't think it's that much of a surprise. I just think everyone's somebody once tweeted me saying, I'm sure somebody started this line, it's like, respect the lag. I think that's an accurate way to think about everything that's going on now, because we're in such a weird environment where things are just disconnected, and the speeds of different parts of the economy are not all in sync.
Respect the lag. That's a good hashtag. I like that. I might use that later. I might steal that.
That wasn't for me. I don't know.
It's like whoever put it up. I might steal it. I kind of like that. But it also brings me a bit to the disconnect. I was looking at the numbers this morning at the market, just pre-market open, and then the market opened, and I was looking at it, like, it doesn't make a whole lot of sense. For example, the DXY was up while the US got downgraded. The US dollar went up, right? So trying to make sense of that. So talking about disconnect, that's where my mind took me here. Run me through that. Why is the DXY up? Like, why is the dollar reacting positive to negative news?
Well, I mean, first of all, markets can do things very differently than what you would think given the headline. I mean, the best example of that, which may still be appropriate to what's happening now, it's just very early, is what happened in 2011 when S&P did the credit downgrade, for U.S. government debt, and Treasury yields fell. Money actually went into Treasuries despite S&P back then saying default risk is actually higher, right? Which is why they had to downgrade the credit quality of the United States government. So, okay. First of all, what's the impact of a downgrade? In reality, probably not very much, except the realization that if the credit quality of the United States government sucks, everybody else and their credit quality has to suck too, because the U.S. government owns us through taxation, right? It's like you can't possibly say, well, U.S. government can keep on being downgraded, and it'll be fine for all the other corporations. No, they're going to tax us then more to pay off the debt. So this is what's so silly about these arguments. So now the dollar rise, I think, makes sense because traditionally, right, the sort of real risk-off plays that benefit from heightened stock market volatility that are not directional bets on equities outright are the dollar, gold, treasuries, and utilities. Kind of the four most defensive parts of the marketplace. So it kind of makes sense that you'd see the dollar rise because it would suggest that there's a little bit of fear that's starting to take place. Now, this is, remember, the DXY is largely euro, right? So
60%, I think.
Right. It's around that number, right? The yen is having a different dynamic, obviously, right? Which we'll talk about too, I'm sure. But the point is that it's like you don't know. I mean, so any kind of volatility, money tends to go into the reserve currency. I mean, that's just the reality historically. Now, the question is going to be, you haven't seen it just yet, as we're speaking today, the day after Fitch did the downgrade. But the question is going to be, do you see a repeat of 2011 where treasury yields on the long end fall? Where you have a short squeeze in long duration treasuries because there's so much short positioning there, where you get this sort of traditional flight to safety dynamic, which you saw for a brief moment in time in March as the regional bank dynamic was playing out, and which people haven't really seen since 2020, where money goes into the safety, in quotes, of U.S. government debt. That's only going to really happen whenever credit spreads blow out, whenever the differential between junk debt and AAA widens, which I still think is coming. But again, this is all very fluid. The dollar seems to be the preferred risk-off play now. It was certainly last year. Maybe that's going to continue. I question which of those four would have the most upside potential, most convexity, if you have a real event.
Looking at treasuries, I think that's an interesting topic to stay on for now, because just this morning, I think, as we're recording this here on August 2nd, the Treasury Department said, well, we have to issue a ton of new treasuries. The total number, I think, to year end is 1.8 trillion. It's $1 trillion. It's an insane number. $1 trillion just this quarter alone. 100 billion next week, right? In various short-term, medium, and long-term debt. Does that play a role as well in the bonds just spiking a little bit this morning?
Yeah, I mean, I'm sure there's a dynamic of supply, and also just if the yen is going to start to appreciate, you're going to have Japan probably selling off treasuries too. But any kind of real fear, the response usually, again, with the exception of last year, which was my hell for my funds, which are rules based, which are automated basically in the way that they rotate, risk on, risk off. Usually it's treasuries. The demand for treasuries would swell that. I'd actually argue that if you're going to unleash a supply of treasuries, and you want buyers, you better scare them to buy treasuries by having stocks go down, right? So that's what I'm saying. I think this is still very early and fluid, but certainly that's the dynamic. The thing is, like, all this stuff is it's out there, right? It's not like it would necessarily blindside, I think, treasury bond investors, traders, holders. So to some extent, I'm going to argue that if you believe markets in general, and by markets I mean all markets, that they're discounting mechanisms on available information, that may already be reflective in the current yield anyway.
I don't think they would go out and say that we're going to raise actually 7 billion more than we did last quarter without knowing they have buyers for it. Because if that happens, if the market takes a whiff, or starts smelling that they won't be able to place all the bonds they're trying to sell, then all hell would break loose, in my opinion.
Of course, then is the guilt. That's the guilt situation all over again, but in the U.S.
Exactly, right, where the Fed has to step in and buy probably their own treasuries. So we don't want to see that. I had a great topic just a second ago. I want to talk about yen is one topic I wanted to talk about as well, because you've been hinting at it, and the yen has been deteriorating while the Nikkei is absolutely exploding, or has been on a tear at least this year. Do you want to catch us up on the yen, on the pair trade you mentioned there, and what you're looking at? Yeah, I mean the thesis, which was really sparked from that reaction last Thursday, where there was just a hint of the Bank of Japan surprising, and it caused a big intraday turnaround on that Thursday last week. The carry trade is a big deal. The idea that because rates have been so low, people borrow against Japan and put that money to work in other higher yielding currencies.
is a big driver of demand at the margin. And it's interesting because if you look at the dollar yen correlation against the NASDAQ this year, it's pretty high, right? So you borrow low and then you take a gamble and take higher risk, and hey, why not, right? You can leverage basically for free. Now, because that carry trade inherently results in leverage and eventually has to be resolved through repatriation to some extent. If the yen were to appreciate, okay, then all those borrowers in yen are now going to have to scramble to some extent. That could spark forced selling in wherever that leverage was put to work in that came from Japan, and then I would argue spark kind of a snowball effect to some extent. And usually also, just like when you see the dollar rise against the euro in risk off periods, you also see the yen rise. Now, in the case of the yen, it can actually cause the risk off period. Japan's in a really precarious situation because the truth is they don't know how the hell to deal with inflation, right? So they've always wanted it, but the problem is they're so dependent upon oil imports for energy that oil, which has already been rising on its own in yen terms, keeps on going higher and higher. The yen keeps on weakening and weakening. That makes inflation stronger and stronger in yen, and that makes for a real problem, right? Because, you know, Japan wants to see wage inflation, but doesn't want to see cost push inflation outpace it, right? And the population doesn't even know how to process that. So I say all that because I think there is a very real scenario, maybe I'm wrong on this, that the Bank of Japan will have to step in to, in quotes, save the yen, to stop it from depreciating. And the only way you really do that is by either really loosening the grip on yield curve control or outright raising rates. But because there's so much leverage tied to that existing setup, that's where you're going to get some really nasty ripple effects that can permeate throughout the entire globe and have all kinds of ramifications on unemployment, because it means credit spreads widen. On housing, because it means the stock market goes down and the wealth effect then isn't there anymore to take on a big purchase. Right, small things can have a big impact. I've been playing with this analogy that, you know, it's in a chaotic system, a butterfly flapping its wings creates a hurricane, but it's Japan's not a butterfly, it's Mothra from Godzilla. It's a big deal.
Now, interesting, because, you know, debt to GDP ratio in Japan is 260, right? The US is 129, roughly 130, let's say half. So that has a big impact. And Japan just earlier this week, I think, announced an increase to their yields. Like, I'm not an expert on Japanese yields in the yen. I think I have to refer to you on that. But it made headline news, obviously, this week, and it caught some people by surprise, right? So what did they exactly do? Maybe you can elaborate on that, because I'm not too firm on it, I have to admit. They increased the yield on their debt.
Well, yeah, they essentially changed it so that it's more of a reference in terms of the yield curve control to have a little more flexibility. And then they had to step in to save the bond market of the weekend. It's like, well, that was quick. In terms of that being a failure. So that 260% debt to GDP, it's like in 08, everyone was always talking about the bond vigilantes, right? Bond vigilantes, I gotta imagine, must be salivating over what's going on in Japan for all the talk about the Fed being late to the game to hike rates with all this inflation. There is no country slower than Japan, right, in terms of their own monetary stimulus, the global situation, cost push commodity inflation, and then their response to it, right, relative to currency volatility, which is coming back, I think, in a big way, right? So, again, I could be totally wrong on this, right? I keep going back to, independent of where the catalyst comes from, you're in this seasonality period from August to October, where in general, the VIX tends to rise. The sentiment is stupid bullish. Nobody wants to hedge when you look at put call ratios and things like that. I keep tweeting, Xing, I don't even know what you call it now, right? With Twitter.
Posting.
I keep saying,
posting.
Yeah, posting, right? It sounds boring. I keep posting that no one is prepared, and it's not like I'm trying to be overly dramatic. It's like literal fact that the hedging is not there, right? That the margin levels are elevated. And by the way, all that can be fine, but how do you have a global margin call when everybody has overly confident and overly leveraged, such that any small change causes a ripple effect? Right, so it could be from Japan, it could be from the Fitch downgrade, it could be from, for all we know, suddenly the Pentagon shows us the UFOs. Okay, that the aliens.
I still don't know what that was about.
I mean, maybe that's the next thing, right? The next, I don't know if that's bullish or bearish. It's like a joke, right? It's like when the balloons were out there and they were saying, "Oh, we can't comment on whether it's UFOs or not," right?
Yeah.
Well, just balloons.
Can't wait to pick up a tabloid in the U.S. grocery store again next when I'm in the U.S. next.
Yeah,
so.
exactly. But it's like, I mean, if UFOs, I bet you UFOs and aliens are bullish because it means they have to do more QE.
Moon mining, or asteroid mining is becoming a reality.
Right.
I don't know. We're drifting off here, but it's an interesting topic, right? Like, what's the story behind that? And I have to ask you one more time about the dollar, because I think that has a lot to do with things and commodities in particular. Because I want to take the conversation there in a minute as well. But as I said, the DEUTSCHE is up today. The dollar. Are you looking at external impacts as well? And I'm hinting at the meeting down in South Africa in Johannesburg later this month. External factors. You mentioned external shocks. I'm thinking geopolitics to a degree here as well. Are you following that at all? Is that something you're monitoring as a leading indicator, maybe?
I mean, not particularly, but you bring up something which is I also think people have forgotten about, which is that geopolitical risk is still there. It's like, again, people only care about geopolitical risk when stocks are going down. They only care about the yield curve when stocks are going down, but none of it has changed. If anything, on the geopolitical side, it maybe got worse in terms of surprises or negative surprises. So no, I tend to be very skeptical of narratives, and I tend to be very skeptical of the way that narrative follows price. And I come from the standpoint of somebody who has skin in the game, where my skepticism has nothing to do with my funds, right? My mutual fund, my 2 ETFs, because they're rules-based, right? But I think it provides context around the cycle and the opportunity set, right? And how to think about risk when you're in a period where seemingly everyone thinks there's no more risk.
Yeah. Okay. No, that makes sense. I'm just looking at your tweet that you just put out earlier, like 2 hours ago. Post 3 hours ago. Watch gold, watch treasuries, watch the dollar, and watch the utilities. Like, I'm not too familiar with the utilities, but I'm thinking energy, because utilities use a lot of energy, and you mentioned oil's been going up lately. Let's touch on utilities for a second, so we cover all 4 topics, but then I want to talk gold as well. What should we watch for in the utilities?
Okay. So I go back to those are the 4 risk-off plays. They are imperfect hedges, okay, which, by the way, we should take a second on just to describe. I'm very anti-shorting and very anti-going puts, making directional bets on markets, because you have to be so spot on timing. Whereas if you express a negative view on equities by either utilities, gold, treasuries, and the dollar, you can be wrong in your timing, but still have a chance to make money because they're imperfect hedges. They still move, in different ways, right? Although they tend to outperform meaningfully when you have the actual tail events. Okay, so the utilities sector is something that I always reference because it goes back to the very first paper I won an award on in 2014, the Dow Award from the CMT Association. That paper is called An Intermarket Approach to Beta Rotation. And what that paper documents is that you go back to the 1920s, when the utility sector on a very short-term basis is outperforming the broader stock market, that tends to be a warning sign of higher volatility on a go-forward basis. So utilities will tend to outperform, be up more, down less in advance of a higher volatility regime, leading, not coincident, not lagging. And that's actually a pretty remarkable phenomenon throughout multiple data sets and data periods from the 1920s. The reasoning there is that utilities are the most bond-like sector of the stock market. So not only are they defensive, low beta, but if there's a feeling by, in quotes, smart money that things will get volatile and all they can do is do sector rotation, they're going to, at the margin, try to rotate out of high offensive positions and go into more stable utility companies, which would benefit when rates fall and benefit from the end of the world because you still need to keep the lights on, right? Okay, so that's the utility side. Utilities were clear outperformers pretty much all of last year. They started outperforming the broader S&P in November 2021, which is when the large cap bear market began. And then basically went round trip, meaning, since late September, before the October low, again, leading from that standpoint, utilities were lagging, right? Telling you risk on, right? Which is consistent with the melt up argument. One of the reasons I actually argued melt up back in October of last year as well. Now we're at a point, though, where utilities are so bombed out on a relative basis because of AI mania that I would suspect you're going to see outperformance, not just in utilities, but in defensive sectors more broadly. right? And if that's the case, under what scenario would defensive sectors lead? Higher volatility, right? So it's all consistent. So my point is that you're seeing it even today, I think utilities, as we're chatting, are actually positive, right? While the broader stock market's down actually fairly sizably. So I think if you start seeing some real, strength in utilities, in the coming days and weeks, that would actually suggest we're probably in it. We're in the correction. We're in, whether it's credit event or not, we only know with hindsight, but we're in a regime shift.
The flippening.
The flippening, right? Yeah, right. flipping from tech to utilities, and I hope from stocks to treasuries.
The flipping. I love that term. I read your tweet. I saw that. It's like I have to bring that up somehow in the conversation here, right? Let's get to the fourth risk-off play here, and that's precious metals, gold in particular. It's interesting that you'd mentioned just gold, not silver. So I'm curious if you're making a distinction there, and if you keep the two separated, is maybe silver more of a base metal, industrial metal for you, instead of a precious metal in that regard. Has that changed for you at all?
Yeah, I mean, I think you framed it correctly. The studies overwhelmingly show that gold does act like a risk-off safe haven. In high volatility sequences, again, I go back to path, not prediction. When you have high volatility, because gold is, I'd argue, the ultimate diversifier, because it doesn't really correlate to very much except those high vol sequences, that gold ends up being an interesting thing to also watch here, because if I'm right that you're in the risk-off period that I alluded to back in January, right, the credit events, the melt-up, and then the crash kind of idea, gold could now surge, because it would suggest what? It would suggest maybe the bear market's not over, right? Because you then would not break new highs and the trend reverses in broader risk on assets. By the way, just at the same time, the lagged effect of interest rates start impacting the economy, going back to the start of the conversation. So at the margin, I'm having some demand for gold, while gold is near the prior all-time highs. Gold then maybe breaks through those all-time highs, and then that creates the self-fulfilling momentum cycle that everybody's been waiting on, right? So silver, I don't, obviously there's a correlation between silver and gold, but the data is much more tied to gold as far as that sort of flight to safety type of dynamic.
No, that makes a lot of sense. I had Julian Brickton on the other day, and he called silver the anti-dollar as well. So if you want to trade or short dollar, you buy silver.
Yeah.
Right. So it's an interesting correlation there. Michael, I really appreciate your time here. Last question now, sort of like, have you shifted your portfolio or the position of your ETFs at all last, let's say 2 weeks, maybe, just to unpack the time horizon? Because that's, I think, the time we've started to see a bit of a trend change in treasury yields and just momentum in general.
So all three of my funds, ATAX, RORO, and JOJO, are totally rules-based, which again means it's not based on my discretion, and they are locked in place in terms of the opportunity set. Yeah. My mutual fund has had a very hard time since 2012 because it's risk on, risk off. It launched right before QE3. You only had 2018 and the 2020 crash for it to shine in terms of late 2018 and 2020. And also, the mutual fund tries to play relative momentum in emerging markets, which keep whipsawing that fund to death, which has been brutal. I keep hoping that you're going to get a tailwind of secular strength in emerging markets, and it hasn't happened for a decade, literally, with the exception of 2017, which was a good year for the fund. So rules-based from that standpoint. RORO and JOJO have indices, and you can see the holdings, they're positioned very differently. This is a tricky juncture, right? Because on the one hand, it looks like we're back to hell. Okay, what I mean by hell is what I was saying all throughout last year. Somebody who saw the failure of treasuries to interact with equity volatility, the flight to safety trade, but couldn't do anything about it because that's what the way my funds are designed, right? Based on the prospectus. So you're seeing right now stocks and treasuries are correlating again on the downside. The real flipping would be if you see what you saw for a brief moment in time in March during the regional bank crisis, where higher volatility means money goes into long duration treasuries, TLT, as your proxy, okay, which means yields would actually fall on the long end and price would spike. Right now, historically, when you have one of those flight to safety trades in treasuries relative to equities, in long duration relative to equities, it's almost like the VIX in terms of the speed with which treasuries outperform equities. Again, we haven't seen that in a while. You had it in mid-March, you had it in 2020. There's a reason why in 2020 my mutual fund did really well, because that happened with the COVID crash. I am hopeful that we're not back to the hell dynamic of equities and treasuries falling apart. If I'm right that the credit event is either here or very close, the conditions favor it, there is a big short squeeze potential out there for long duration treasuries based on CFTC data, based on sentiment. And the reality is the credit event means spread widening, which means money goes up the quality scale, ultimately to the pristine asset. This is why I go back to the reaction in 2011 with the S&P downgrade wasn't that yields rose for treasuries, is that they fell as credit spreads were widening, because the implication is that if U.S. government's in trouble, everything's in trouble. So long-winded answer, but I always need to emphasize that point. There's a difference between me as a thought leader, if you want to call that, an analyst or a researcher, and then me as a portfolio manager of funds, which I'm an investor in as an entrepreneur, that is based on my intellectual property. It's a very specific way in which they run, but are not based on my thinking, right? So usually when you're in a real risk-off period, all the signals align. So the funds would all look the exact same way being in treasuries. You're not there just yet. I am hopeful that that happens, because candidly, that's the only real way I can come out of the drawdown last year.
Fantastic, Michael. Phenomenal conversation. We have to wrap it up here. We're out of time here. Unfortunately, I could go on for hours with you. We haven't touched on so many topics yet, like consumer sentiment. How does that all fit together? Because there's a divergence happening. It seems like white collar, blue collar, and all sides of the spectrum. There's a massive divergence happening that we still need to discuss. Love to have you back on the program sometime soon. Love to chat again. Really appreciate your time. Thank you so much. And let me. Wait, where can we find more of you? Obviously, I feel like everybody knows where to find you, but I still want to bring that up. Twitter's the best way.
Yeah, I mean, Twitter or X, whatever. YouTube, Instagram, leadlagreport.com, the Substack. I put a lot of content. It's like I've learned over the years, having done this for well over a decade, doing the media stuff. The key is to say the same thing 500 different ways. And I try my best to be creative in that, because the reality is it's boring if you just present facts. You have to put a little bit of color around them, which is funny because I always rant against narratives, but I'm also the one that has to use narratives to get the point across.
That makes sense. GIFs help a lot as well. So
memes are a big part of that.
Yes. Exactly, right? Fantastic. Michael, thank you so much for your time. Everybody else on Soar Financially, thank you so much for tuning in. We hope you enjoyed this conversation with Michael. I sure did. I was looking forward to it for a while. Really glad we could make this happen. This is only possible because you've been subscribing. Right here, there's a button. It says subscribe. We've been growing the channel, but I know still 80% of you watching are not subscribed. Let's change that. Let's get that number up. We would tremendously appreciate it. Would help us bring Michael back on the program, bring other great guests of caliber on the show as well. Really appreciate your time. Thanks so much for tuning in. We'll be back with lots more.